Hey guys, welcome back. In today's video, we are talking about how shorts have to report on a monthly basis, why FTDs will harm shorts, the cat exposing, and many more in this video. First, we're taking a look at this. Starting January 2nd, 2025, managers holding short positions exceeding $10 million or 2.5% of a company's shares must file Form Show on a monthly basis. This measure is designed to increase transparency in short selling, helping regulators and investors better detect market manipulation and mitigate systemic risks. So what we're seeing right now is, again, more and more rules that are being pushed out in order to try and find transparency in the market in order to increase it. Now, the reason why I think this is happening isn't because they want to help retail investors, but rather I think we should take it as a way of understanding what they're worried about is about to happen. We're seeing more and more regulation, more and more rules on the margin requirement, on the collateral requirement, and now again on the short requirements. And all of this is obviously for a reason. One of the biggest things to obviously take away from this is that in 2021, obviously the situation with AMC, GME, and many others clearly shown that there was a massive risk involved in the market. Going throughout the years, these risks are still existent. We're seeing the derivative positions of banks to be in the trillions and even bigger situation. So it's obvious why they're doing this. But this shows us right now in terms of how we can be seeing short sellers in terms of panicked, how we're going to be seeing the increase in potentially the FTDs, but not only that, the different ways, the loopholes that they will try and use. I suggest in terms of something that I think is going to happen is obviously it may not require them to report offshore like they did in the past, and that may be something that obviously needs to be looked into. Now, another thing, and again, this is actually relating to what we see here. So here they're obviously trying to detect market manipulation and mitigate systemic risk. And you can see why they're doing this, because following up, we have this. The SEC says releasing GME FTD data would cause foreseeable harm. So what we see is that they claim that releasing the data could cause foreseeable harm. This is particularly frustrating to the retail community as the SEC routinely publishes similar FTD data. So like we talked about at the start, and again, there will be others in this video as well, that further highlights why shorts are obviously worried, why FTD is a massive issue. But first, we're looking at in terms of just this whole situation with how FTD itself could cause foreseeable harm, and that's why SEC is obviously not releasing it. In the past before, there have been many times where we've caught short sellers doing shady things, doing manipulative things, and things that suppress the price of AMC and GME. And these were data that we've gotten because we understood what was happening with the FTDs. We knew that if the FTDs were at a very high number, they borrowed a lot of shares and they couldn't settle it, showcasing the reason for how they were able to suppress the price. And again, the fact that they are failing to settle these shares, the fact they are failing to obviously be able to locate these shares as well. And so this is what we're seeing right now. And this is, when we saw this whole FTDs, this was at the very beginning. And now fast forward, we're going to 2025, we're going, and this is for 2024, we're still seeing the same situation about how FTDs is very likely to showcase the corruption that's happening in the market. It's showing how they're using FTDs to obviously manipulate and suppress the price. But more importantly, it gives us an even better understanding that right now they are still trapped in this play. Foreseeable harm. This isn't obviously going to be applied to the retail investors, because how could FTD data being released harm retail investors? Retail investors are doing nothing but obviously buying. No one is shorting. So how could that obviously, in terms of damaging us, how could that cause any harm to us? The only reason why it would cause harm is because it would showcase that there are tens and hundreds of millions, if not billions of shares being shorted that are not able to be located and being settled. And that's why it would cause harm. Another reason to understand this is you can see, did you notice who is on the CAT advisory committee? Look at the orange ovals. Almost half the committee is staffed with known short sellers of AMC and GME. It's staffed with those with the most to lose if the CAT system is strong and robust. So something that we talked about in the past before is in terms of people who are on the committee for the CAT system. Now, we talked about some stuff. You can see Northern Trust, Citibank, Jane Street, Credit Suisse. We've also talked about Citadel and Virtue. And now something that we have to understand is that people who are on the CAT system are also some people who are, of course, shorting AMC. Not everyone, but there are some that are obviously involved. And this is why we're seeing in terms of the resistance with CAT system. It's why I think, we're doing 50-50. Firstly, we're getting them to report this. And one of this in terms of transparency, obviously that's what the CAT system is supposed to do. And that's why likely we are obviously seeing managers having to obviously report their short positions. Now, the fact that if it's not obviously more detailed, there is more ways to find out the loopholes, then that could obviously be because the short sellers are trying to prevent this from happening. Another thing in terms of understanding how the CAT system is obviously helping us is obviously because of the data in which it's getting. Now, the FTD data is something that we've always gotten, but with the CAT system, we're obviously having the ability to obviously track every single transactions, so we could actually match every single FTD that are obviously out there. And that's why it's, again, another thing that will cause harm for these guys, but it's why we're seeing them, doing all of this. And so this is why I think whilst the CAT system is obviously bringing the transparency, more needs to be done. One of the things we talked about is, of course, the consequences. We've seen firms who are making billions of dollars suppressing, manipulating the markets, but only have to pay a fine of mere millions. This can be looked at as a cost of business, because if you're able to make 1 billion and you only have to pay 5 million, I'm sure everyone will take up on that deal. And so one of the things is that obviously we need a better consequence. We need a harsher consequence, but it's also understanding that is everyone in the CAT system, which is of course supposed to be bring transparency, bring fairness, and helping the retail investors, is everyone in the CAT system committee actually on board with that, actually trying to help retail investors and not just benefit for their own firms? Because another thing you have to look at was in terms of, was an interesting read on fractional shares and their problems. Here are top 50 fractional shares traded stocks. Some really interesting names on this list, especially when looking at their chart. So when you look at this and you look at the in terms of the fractional shares, something that you can see will obviously be AMC and GME. Now, we talked about in the past, fractional shares is something that you can use in terms of manipulate the price. And so whenever you're looking at a method that could manipulate, that could suppress, that could alter the price of a stock, you're very likely going to be seeing AMC and GME on that list. And this is very obvious because wherever you're seeing they have crypto tokens, wherever you're seeing fractional shares, wherever you're seeing at the most shortest stocks, the most exposed stocks, these are all stocks that will contain the names of AMC and GME. And when you do see that, it always appear on these lists, it makes you wonder what is actually happening. Are the shorts actually out or are they still trapped? Now, like I've said, there will be people who say that the short sellers are out, but I've always said, and again, we've seen it with the data in these videos, is that so many data are all leading to the fact that shorts are in fact not out. They have not covered their shares and that they are still trapped in this play. And you can see this with these lists. You can see this with the CAT system committee. You can see this with a statement made by SEC in terms of causing foreseeable harm. You can see it with how they want to bring more transparency and mitigate systemic risk. These are all factors showing that they are obviously worried. But another thing is looking at this, the reverse repo. So what we're seeing is the reverse repo to be actually at $239 billion. So this is obviously an increase since when we've looked at it last time in terms of 93 billion. It was sub 100. And bear in mind that on December 31st, reverse repo was 473 billion. So you can see how we're seeing massive volatility, massive influx in the reverse repo right now. We've gone from 93 billion all the way to 473, and now all the way down to 239. And what we're seeing is, of course, the need for money, the need for liquidity. The very fact we're seeing the influx, the very fact we're seeing the volatility of reverse repo is showing that there is something happening. It's showing that in different times period, in short term, they are in need of money. And this goes to what we talked about here, and in terms of why this is important, is that crypto is an OTC derivative product enabling margin requirements on debt instruments. Not sure how anyone can believe it's DeFi at this point. But it's something that we need to look at in terms of, firstly, how they talked about, cryptocurrency can't be used as a way of collaterals. But then we've seen the increase of funds on cryptocurrency, on the ETFs. We've seen that with BlackRock, we've seen that with others. And now these funds could actually be used as collateral. So whilst they've said that crypto can't be used as collaterals, they found other ways of utilizing crypto as collaterals. And these are obviously the loopholes they're always going to try to do. But the important point here that I want to talk about is the fact that if they need all of these ways to find margin, to find liquidity, to have collaterals, then it clearly shows that they are, of course, in need. It shows that something is happening. You won't need so much liquidity if you weren't struggling with some stuff. And in this case, it's obviously with their short positions, it's obviously with how over risk they are, and that's why they need it. Anyway, guys, thanks for watching the video. I'll catch you guys next time.